All right, so tonight we're going to start out looking at the chapter 12 handout. And we got down to, okay, so just kind of bring us back to where we were last time. So we evaluate the client's plan for the physical inventory. And what you're really doing is looking over to see if, well, first of all, to see if the dates are, that you can make the dates and all that kind of stuff. But also just to make sure that it's going to be adequate for what you're looking for. It's going to be well planned out and what they're trying to, that their plan looks like it will be achieve the kind of inventory that we want. Okay, now the next thing you're going to do. So if you think, okay, you're okay with their plan for it, then you observe taking the inventory. Okay. So what we're looking for when you're doing it is existence and condition. And you're going to make test counts. Now, for the most part, this existence and the test counts are probably the main focus of it. That you want to see, the test counts are there to see that it exists. But this condition, so the condition kind of goes to the valuation of it. And usually before they do an inventory, anything that is obsolete or damaged or whatever, you'll have that separated. You'll separate that out from the rest of the inventory so that it's known that, hey, this is special. This is not our normal inventory. This is stuff that's, it's obsolete. It's there's something wrong with it, whatever it is, it has to be discounted, that the value of it might be in question. So looking at the condition of it, is one of those things that you do to just to see if it is saleable. And if it's not, or if it's not saleable at full price, that has something to do not with the counts necessarily, but with the valuation. So this one is really points towards valuation, which is not the main focus of a inventory, a physical inventory, but certainly if you find something that it is. I'll tell you a weird one. When I was at US Steel, they have steel makers. They roll out. It comes out like a big tube of toothpaste, steel it's like 6 feet across, maybe a foot deep, and they run these out and they go out 20 feet. Sometimes they go out 40 feet, and it goes continuously. It's like a tube of toothpaste that runs continuously. You can't shut down the steel making part. So anyway, the thing that cuts them, they had a problem with the thing that cuts them. And they had the slab that came out, and I say most times they're 20 feet, sometimes really big ones will be 40 feet. They weren't able to cut it for whatever reason, and it went out to 120 feet. So this thing's 120 feet long, and it weighs, I forgot what it weighed. It weighed something like, a 250,000 pounds or something. It was some like absurdly large, and they didn't know what to do with it. Obviously they were going to have to cut it up, but cutting through a foot of steel takes a lot of doing. So anyway, they were debating whether to have that on the books as inventory or as a liability, because it would probably cost more to cut it up and roll it or whatever than it was, what it was worth. So it was kind of looking at it, well, I don't know, is it, and the steel, there was something wrong with the steel. It was just the size of it was kind of an odd thing. Okay, so you make test counts, and as you go along, so the way that happens is you'll go along and there'll be tags on the inventory, and you'll take your test counts, you'll write down whatever the tag number is on it and do your test counts on your own. You won't obviously take the test count that the people taking the inventory are doing, but you'll do a test count, for instance, for tag 792. So tag 792, you'll do a test count, and then when they get done counting, you'll compare your test count to their test count. So that's kind of the idea behind taking the test count. Okay. So you take these test counts and they'll be compared to them later on. And depending on the inventory, you can also specifically target some inventory that you might worry about, that you might think that either be possibly a bad count, or maybe inventory that is more valuable than others. Materiality still comes into play, right? Someone taking inventory for stuff that's very expensive is obviously going to have a much bigger materiality than something that is very inexpensive. So a lot of times when you do your test counts on that, you're going to focus on those larger items that perhaps if one of those things was off, it might make a difference, whereas smaller items, it may not make that big a deal. Okay, observe compliance with management's instructions. By the way, these are the people taking the inventory are operational people. So management made this plan out, and so what we're going to do is observe to make sure that they're, if we're comfortable with the plan, obviously, see that they are actually following it when they do it. Now, these are operational employees. Sorry, it's common to have accounting employees, internal audit employees, and external audit. Observing the physical inventory. So you'll have accounting department people internal audit people, and the external auditors, CPAs, all observing the inventory. It's very common to have several groups doing it. But generally, the inventory is going to be taken by the operational employees. So the operational people are the ones that actually do it. And you say, well, why don't the auditors? Well, auditors aren't going to do it because they need to be unbiased. And the accounting people are the same way, that they are the ones that are they're merely accounting for, they're merely recording what they're doing, but they also want to make sure they're doing it. Now, if you've been around when an inventory is being taken, sometimes the people aren't terribly enthusiastic about it. A lot of times they're coming in on a Sunday or something, and so half of them are hoping the building will burn down or something. But so sometimes it really depends on who's doing the inventory as far as what kind of cooperation you get. But generally you have to make sure that they are adhering to what management came up with. Okay. Obtain audit evidence about the reliability of the accounting procedures, and that's usually done by the this is usually performed by the counting of the inventory. That all inventory tags and sheets are used and that they are accounted for. So they use all of them, because wherever there's an inventory tag or sheet, there should be a inventory going on, and that they are accounted for. In retail, you'll see there'll be SKU numbers. I don't know if you guys ever did retail inventory. They have you look up the SKU numbers. I think it stands for stock keeping unit or something like that. I can't remember. I'll have to look it up. No one ever calls it that, though. I'll just call it SKUs. But so they should be writing down the SKU numbers if there's SKU numbers on it, if it's a retail. And the SKU numbers a lot of times will, because you can correlate those to the cost. Okay, review the year end cutoff of purchases and sales. We talked about that already. The cutoff. The cutoff for purchases is usually focused on the receiving department. So what you do is you go to the receiving docs, and what you're really looking for are the last things that come in. When is the cutoff for those last things that come in? And there should be receiving reports made for all those things that come in, done on that day. Now, those are technically, if you think about it, when you receive something, at that point, two things happen. It goes into your inventory. It's on your premises. So even if you haven't got an invoice for it yet, you haven't paid for it yet, it's on your premises. So you have it in inventory, and you also have a liability. Now you owe somebody for that. So notice that there's two things that happen when you're receiving inventory. So anything that comes in at that end, the last day, you're going to go and check for receiving reports. Even if they're not matched up with invoices or anything else, of what came in. or even stuff that has been put on, on the docks that they don't have receiving reports for yet. Note that those things need to be put on as being received, because they'll trigger two things. They'll trigger a inventory, they'll add to inventory, they'll also add to the liabilities. So. So they'll add to inventory and accounts payable. So anything that's on the loading dock. I'll add to inventory. Okay, now for sales. What department would you focus on for sales?
Marketing.
Could be. More more specific would probably be the no, I'm drawing a blank on it. Shipping department. Well, let me change this again. Get the same as upstairs. And we kind of did this before with accounts receivable. The you basically look at the bill of lading. Items not shipped by year end. Oops. Can that be considered sales? And items should be in ending inventory. Okay. Observe the control of the inventory count. I don't know, there's not too much to write on that, but. Good. Simply collected. And every tag or sheet to be accounted for. So they should be centrally collected so that you can actually count them. They'll be serially marked. You know, 1, 2, 3, 4, blah, blah, blah. And all of them should be accounted for. If you're missing any, that could very well mean that some of the inventory wasn't counted. And by the way, these inventories, the ones that I've been on anyways, there's almost always something strange that happens. You know, there's always an inventory tag that falls on the floor, falls in between the coats or something, and you can't find it. You're looking around, and then all of a sudden, you shake the coats and it drops on the floor. And so, a lot of times there is those strange things. When I was at US Steel, there was some steel that was kind of over alongside a building for some reason. It was pulled off for some reason and set there until they figured out what to do with it or whatever. And those are the kind of things that you want to make sure that they're included in the inventory, that somebody knows that they're there. And it was kind of funny because the internal audit group, we were observing it, and 3 of our people, including myself, spotted it and put it on there. Oh, by the way, there's there's some steel over here, and then someone else in the accounting department. I think one person in the accounting and one of the external auditors also came up with it. So it was really reported 5 times because everyone was sure that everyone else was going to miss it, but nobody did. Okay, and I think I talked about this. Maybe I didn't. Purpose of the inventory tag. Did I talk about this? Can't remember. I did not. The purpose of the inventory contains, okay, that's why it's here. That everything is counted. And secondly, everything is only counted once. And that's why we have these tags. There's serial numbers, so we know that everything is counted. We won't go out and attach them to it. And then, but also that it's only counted once. You don't have more than one person counting, the people group counting the same ones. Okay. Obtain a copy of the completed physical inventory and test the clerical accuracy and trace the test count. So basically what they're talking about here is a lot of times, well, first of all, just seeing if the numbers add up. So if they say there's 15 codes and you look at the SKU numbers, there should be 15 SKU numbers. So you're testing that the counts are correct. The totals are correct. And you're also comparing your test counts to the actual completed inventory counts. So you do your test counts. And by the way, here's another thing about auditing. If you're doing it as an auditor, generally you arrive before everybody else does. When they actually have the tags on all the inventory, that's generally when you go around and do your test counts. Because it depends on what method they're using for doing the counts. But sometimes they'll do it where they have the sheet you know, and then people go take the sheet, do the count and turn the sheet in. The problem is, if you're an auditor and you're doing a test count, if they take that sheet away, you won't know what the sheet number is or the tag number, depending on how they do it. So what you generally do is go out before everybody is, you know, taking inventory, or go to where they're, or even if they start taking inventory, go to ones where they haven't taken the inventory yet and do your test counts there. Because a lot of times the tags will be taken off so that it isn't counted twice. So, you know, just as a logistics thing, you go out early, count them. Okay. Number 6 seems like a very mundane thing, but 6 and 7 are actually very important. I know it sounds kind of strange, but there are literally dozens and dozens of ways to keep inventory. The inventory pricing of inventory is called, it's an allocation. That's how they will deem it. It's how do you take the costs and allocate those to the inventory. So it's an allocation of costs to the inventory. And so how that happens, it can happen any number of ways. Sometimes they'll have, you know, LIFO, FIFO, obviously, but they'll also have things like LIFO pools or FIFO pools. What would that be? That's usually like all the purchases for January will go into a pool, and whatever the average cost is for that will be a LIFO pool or a FIFO pool. And there's all different kinds of ways of doing it. And the real only 2 criteria for an allocation is that it be systematic and rational. What am I doing? Yeah, I'll do it up and here. That first to be systematic. And second, that it be rational. So there are many, many ways of doing inventory. And companies do not have to use the same inventory method for all of their inventory. It's not that uncommon to use average cost for some things and LIFO for other things. What does systematic mean? You say you have a system for something. What does that mean? Anyone? Yeah, it could be anything. I have a system for folding clothes. What does that mean?
You have a process.
You have
Yeah.
a certain way of doing it.
Exactly. It's a process and it's repeatable, right? You know, so this is that it and repeatable with the same results. And by the way, you know, with the allocation, things like depreciation and that fall into these also. So it's repeatable with the same result. So, you know, that if I I fold my sock, I don't know, however I fold my socks, that, you know, if I have a system for doing it, that is repeatable and that it's gonna they're gonna be folded the same way every time. All right, what does rational mean? Rational just means what?
Almost like a common sense type of process.
Exactly, exactly, you know, that it makes sense. Or common sense, another reason. Another way of saying it. Yeah, that makes sense. There's common sense that, in other words, it some way relates to what you're doing. For instance, if we wanted to allocate the cost of the inventory based on, you know, the colors of the inventory, the blue things could be, you know, the highest price, and, you know, orange things you get the second, you know, all that kind of stuff. It'd be systematic, you know, you could do it that way, but it wouldn't make any sense to do it that way. So it has to be systematic and rational. And when it comes right down to it, those are the only two criteria. If you can come up with a way of taking inventory or doing depreciating something, if it's systematic and it's rational, it's that really is, you know, the criteria. Now, of course, we do have LIFO, FIFO, and all that kind of stuff that are systematic and rational. We have you know, units of production for depreciation, straight line, and all that stuff. But those are the criteria. Okay. Now, testing the pricing of the inventory. The pricing of the inventory oops. Pricing of the inventory can be the easiest to manipulate. I should say, I don't know, you rephrase this. Easier than the test counts. The pricing of the inventory, you know, if you're gonna cook the books with inventory, doing it with the test counts can be difficult because everyone's watching it, and you know, like I mentioned earlier, you'd have 2 or 3, you know, different groups watching it, and probably 2 sets of auditors. The internal auditors and the external auditors will probably be watching it. So that's a lot of people watching. You know, if you're going to try to do it with a test count, you know, the test counts and that sort of thing, that can sometimes be a little bit, you know, of a problem if you're going to cook the books and say your inventory is worth more than it really is. However, manipulating costs on some things, it's difficult to know exactly what the cost is. A lot of times these contracts are written up in such a way that, you know, there's discounts and there's allowances and all these other things that come into play that can make inventory either look more expensive or less expensive. So if you're looking at simply cooking the books based on the inventory, whether to make it higher or lower, it's generally easier to do that with pricing than it is through the counts. Again, it takes both of them, but at the same time, there'll be less focus on the pricing than it will be for the actual counts of the inventory, which have several people involved, many people involved. Okay. Perform analytical procedures or data analysis, analytics, analytical procedures. I don't know if we talked about those, did we? We talked about analytical procedures. They're sort of like they sort of point you to where problems are. For example, if sales go up, so let's say the sales go up by 10%. What would you think would happen to the inventory? You know, if your sales are increasing, do you think you need more inventory or less?
More inventory.
More inventory. So if sales go up, you expect, okay, inventory goes up. Now maybe the sales go by 10%, maybe they don't go up by 10%, maybe it goes up by 8 or whatever it does. But generally speaking, if you have more sales, you're going to have more inventory. So if you have more sales and inventory goes down, that could happen, obviously, but it could be also indicate there's a problem. You know, so analytical procedures are looking for kind of what they call plausible relationships. If you have more sales, you're going to have more inventory. If you have more sales, you're going to have more stores. Those stores are going to have inventory and whatever. So, you know, analytical procedures are looking for plausible relationships between the data, and it doesn't have to be financial. It could be, you know, even a physical count of the inventory. What is that? I shouldn't say look. So they should indicate. The analytical procedure should indicate plausible relationships between data. Oops, give me 1 second here. If your inventory goes up, what should happen to the number of deliveries of inventory? Go up, right? You know, if you have 5% more inventory, you'd expect there to be more deliveries of inventory. Maybe not 5%, but you know, whatever it is, you'd expect that there'd be a higher amount of deliveries and things like that. So these are all things you gotta look at that it would make sense. It's plausible that if you have more inventory, you had more deliveries. So you can look at the number of deliveries of inventory. If that's a non-financial number, you know, maybe they have 10 a day, now they have 12 a day deliveries or whatever it is. But analytical procedures are for looking for plausible relationships. Now, although it looks like it's number 8 on our list here, analytical procedures are required by all external auditors because they are so good at finding fraud and misstatements. And they're required at the beginning of the audit and at the end. I'll take on here. So analytical procedures, even though they're doesn't look like they may be very important here, they are actually extremely important. They're so important at finding problems that they are required. You have to do them. You cannot say we didn't think it was necessary at the beginning and at the end of the audit. So at the beginning of the audit, you use analytical procedures to see what the problems are. Go make your tests out so that you can go test it. So for instance, if their sales went up, but their inventory went down, you're gonna want to go test that inventory and sales a little more stringently because could be a problem there. And you also do it at the end of the audit. And at the end of the audit, during the audit, a lot of times you find stuff and you say, okay, you need to correct this, and they go correct it. And then you go, oh, well, they need to correct this, and they go correct it. And so the numbers a lot of times will change. And then you do them at the end of the audit, say, okay, do these still make sense? Because now that they've changed these numbers, it might be that there's something else that gets highlighted that we need to look at before we wrap this audit up. When you change the numbers, there might be other things that pop up as being unusual or that maybe are not plausible. So they're required at the beginning and the end of the audit. Okay. Well, I've been talking a lot. Hey, we're almost done. Okay. Determine any inventories that have been pledged and review purchase and sales agreements. Okay, so there's actually two different things. So pledged. No. Okay. And sometimes when they pledge inventory, they have to get approval from the bank to sell it. Because the bank will say, okay, yeah, you can sell it, but then you gotta pay off, this amount. So a lot of times they'll not a lot of times, but sometimes they'll be pledged collateral. You need the bank's approval to sell something and that you sell it for more than they gave the loan out for. If you paid $500 for these things, you're trying to sell them for $400, the bank's not gonna be happy about it. Pledges collateral for $500 worth of a loan. So inventory being pledged, it could also hamper their sales of that inventory. Okay, purchase agreements and sales commitments. The audit. It's a violation of purchase and sales contracts. Okay, and this is one of those things that is very important for an audit, and that is that the users of the financial statements one of the things that you have to pay attention to are contracts. Now, it depends, how they're reporting their, their inventory and their sales and all that kind of stuff. You have to see whether they are in violation of contracts or what those contracts are and how they could impact those financial statements. For instance, sales commitments. They might have a contract that says they have to have at least, $10 million worth of inventory of whatever on hand. Because whoever they're supplying says, look, we have to be able to, get this inventory in quick. We can't have our production line stop waiting for windshields to come from you guys. You have to have a certain amount of inventory in stock. And it's possible at year end they don't have that. Maybe they don't have the number of windshields. I'm just making that up, but whatever the inventory is, maybe they don't have it in stock. And so even if it's off by an immaterial amount, but if it violates a contract, it could be material. Because whoever has that sale at the other end of that sales contract with them might be looking at the financial statements to say, oh, wait, do they have the inventory that we say they have to have, according to our contract we have with them. So things on the financial statements that would be in violation of contract, even if the change is not material, maybe they're supposed to have $10 million of windshields and they have 9,800,000 of windshields. That's violating the contract. So maybe that $200,000 of windshield is not that big a deal. Materially, to the rest of the financial statements, it might be a very big deal because it violates a contract. And whoever reads that is going to be depending on whoever reads the financial reports is going to be depending on that to know whether they are in compliance with the contract. Okay. Because we have a disclosure. Yeah. The methods of the costing methods for the inventory must be disclosed in the notes of the financial statements. So they have to tell it LIFO, FIFO, average cost, anything like that. They have to put in those so people know. And again, they don't have to use the same method for all of it. It could be that, for these sales, we use the average cost. For these sales, we use LIFO or whatever. But they have to disclose that. All right, I think we talked about this testing of floor to book, book to floor. We talked about that. This is a common common types of tests. So this first test, testing of inventory from floor to book, you take on the sales floor, and trace them to the general ledger or the financial statements, the book. Okay, now, what is this testing for? Funny. Okay, so this is testing for A. Existence, or B, completeness. Which are we testing for here? So you go pick up something on the sales floor. can of soup. And we go and we see that that can of soup is on the books or in the general ledger. What are we testing for?
Existence.
Actually, we're testing for completeness, that the books are complete. I should make it one color. And it doesn't matter, I guess. Yeah, so you want to make sure that everything that's on the floor is in the general ledger. Okay, second one here, you probably know the story of this before you started. Is you take items. Oops. From the book. And trace them to the sales floor. I'm sure you all are way ahead of me on this one, and that this is testing for. Oops. Existence, does it exist? They have it on their books, but does it exist, or is this just fake inventory? So you go to the book and say, okay, here's the stuff on inventory, we got to go check out, make sure that it's on the floor. And you're checking to see if it exists. I had kind of an odd one with that one time. I was at an engine plant. And I picked some engines to go test that were in the inventory. I couldn't find them anywhere. And so I'm going around, I said, look, they have these engines and they're, and one of the reasons I picked them out is they're kind of expensive engines. They weren't your run-of-the-mill engines. They had these engines that are set up, and I looking at them, and people in accounting didn't really know too much about them. And so I was asking around, and finally I got that these were what they call mule engines, that they were engines that were made to specific specifications, and they would take them and run them on stands for hours and all this stuff, that they were in this testing facility. And so I went there, and that's where they all were. There are these engines that were made to very exacting specs, that they want to know how many miles, how many hours does this engine go before it fails and all this kind of stuff. But even though it was inventory, it wasn't actually on the floor. You wouldn't sell those engines. So, okay, let's, obviously we're done with this one, so let's stop there. Okay.
Thank you.
Very good. No problem at all. And this will be recorded, so you can always look at it. Okay. So I'm going to save this. And we come back. I can't remember what we're doing with the sampling overview. I can't remember where we stopped. So you did that. Oh, here we go. Okay. So let's say be back at oops. What time is it? 6:56. So let's say 7:06. And we should be able to finish this one up. Okay. Okay, oh, I'm late. All right, allowance for sampling risk and precision, and sample size. A lot of this is kind of your basic. Stat stuff you guys probably had in other classes. Suppose you had a sample that indicates accounts payable had a projected value of 100,000. And it had a standard deviation of 5,000. What would that look like? Well, if you want to be 99% sure, you'd have to go 3 standard deviations away from the 100,000. So if it indicates that the projected value is 100,000, you're going to be 99% sure. It would be plus or minus 3 standard deviations. If you only need to be 95% sure, you're looking at two standard deviations. And 68% sure is 1 standard deviation. And there's variations in between these. There are tables you can look up and see how far out you want to be. Which, by the way, this is a normal distribution. This is why we like to use it, because there are so many tables along with it. So, for instance, be 95% sure, it'd be plus or minus 10,000. So this would, I have it down here? No, I don't. So for this one, you'd say, okay, I'm 95% sure that it's between 90,000 and 100,000. Down here, if you want to be even more sure, given the same sample, I'm 99% sure that it's between, wait, this is wrong. Sorry about this. So this would be the range if you wanted to be 95% sure. You want to be 99% sure. Actually, a little more than that. It would be between 85 and 115. So the more sure you are, the wider this is going to be, the wider this range is going to be, the more the allowance is going to be. So the lower the sampling risk, the lower the risk of error, the higher the allowance. Okay, test controls. We talked a little bit about these earlier. These are yes/no tests. And these are not for dollar amounts usually. Oh. Okay, so these are not used for dollar amounts or material misstatements. That's the controls, all you're trying to do is figure out if you can rely on the controls or not. Okay. Control level that requires 2 managers' signatures on checks written for more than $5,000. So if there is a check written for more than $5,000, it should have 2 managers' signatures on it. And why do you think they have that control? Why do you have a control that you have to have 2 managers sign off on a check for more than $5,000?
Because usually both of them don't be in agreement on maybe stealing.
Well, yeah, it brings somebody else into it so that you don't have people making large dollar amount decisions.
By themselves. Mhm.
Yeah, so it's a control that kind of the more people you bring in, generally the safer it is, let's say. Which is why a lot of times they'll have 2 people, doing a job together, because even if even if one person might be inclined to do something, whatever, to get 2 people is very rare.
Mhm.
That happens, but very rarely does it. Okay. And so again, these are this is what they call a binomial. It's it's yes or no. Either there are 2 managers on the signatures or there isn't. So it's a yes or no. There is no variability in it. Okay. So the auditor chose a sample of 200 checks written for more. The auditor allows for an error rate of 7%. So the auditor says, okay, if there's an error rate of 7%, I'm okay with it. The allowance for sampling risk is 2%. Now, I'm going to head back up here. So what this is saying is that, as a percentage, the allowance for sampling, that it can be on either side of this is 2% based on our sample. So it could be plus or minus 2. And usually we're looking at more like the plus 2. Okay, so they take 200 checks. 194 of them are okay, 6 of them are not okay. So what is the error rate? Oops. So I've got 200 checks. 194 of them are okay. 6 of those are not okay. They only have 1 signature on them. So what is the error rate of our sample? Anyone? You can put it in chat if you want.
3%.
Yep. Good. Yeah, so we had 6 errors. Divided by 200 in our sample. And 3%. All right, so yeah, we had these so our error rate is 3%. Now, our allowance for sampling risk is 2, so this could be 3%, basically plus or minus 2. Now, the -2, we're probably not too worried about, if the error rate, actual error rate is less, but the +2 is more and more we're worried about. You could do it -2 too. If it's a regular two-tailed test, it'll. So 5% is the upper limit on this. So worst case scenario, we have this error rate that we observed at 3%. This could actually be plus or -2, but we're not worried about -2. If it's less than 3, that's even better. But we're worried about the +2. We're worried about the high end over here. So, would we be okay with this? The auditor allows for an error rate. 7%.
Yes.
Yeah. You rely on the controls? Yep, you would. Yeah, because the allowed error rate is 7%. And the observed error rate is 3%, but there's a 2% allowance for sampling risk, so it could be as much as 5%. So 5% upper limit. Oops. So So the 5% upper limit is less than the allowable 7%. So we would say, okay, this is okay, because we'd allow up to 7%. So 5% is even better. We would rely on these controls. Okay. Now, what we're going to do is compare the auditor's assessment of internal controls down here with the actual control. So, there is an actual amount of whether the controls are okay or not. And the true amount, whether they're adequate or inadequate, will not be known completely for doing a sample. But the actual effectiveness of the internal controls, we're going to see if they're adequate or inadequate. If we come up with the same thing over here, what would this look like? So if we, as auditors, say, okay, these controls are adequate, and the actual is that they are adequate. The actual is that they are. So the auditors say they're adequate. So this will have the correct result that we are looking for as far as our sample matches up with what the actual is. And same thing if we come up and say, okay, these controls are inadequate. And in real life, they are inadequate. Again, we came up with the correct decision there. Okay, now these, these two are the problem areas. So let's take the first one here. Suppose we do our assessment in internal controls and we find that they're inadequate. But they're actually adequate. For whatever reason, our sample did not reflect what it should have. This will lead to a incorrect rejection. And inadequate, so we think they're adequate. We think we did our testing, we came up, okay, this is fine, but in real life, they are inadequate. This will be incorrect acceptance. Oops. Try that again. Let's try it a third time. Hey. So this will be an incorrect acceptance. We accepted it when we shouldn't have. We thought the controls were okay, but they're not. Which one of these is the most dangerous? Which one of these will lead you to think everything's okay when it really isn't?
The incorrect acceptance.
Yep. Yeah, incorrect acceptance will lead to an ineffective audit. Because you think everything is okay when really it's not. Incorrect rejection will lead to an inefficient audit. You say, okay, we can't rely on these controls, you do a bunch more work, because you can't rely on the controls, you do more work. You come up with the correct, ending result, it'll just be that you spent more time and money getting there. So this is an inefficient audit. Now, this audit, you'll still come up with, unless something else goes wrong, you'll still come up with the, correct result, and everything will be okay. Whereas this one, you may very well rely on it, that the controls are okay, cut down your testing, and lo and behold, a material misstatement would be allowed. So, and by the way, people say, well, how do you get rid of it? You can't. If there is an audit and you're taking a sample, you're going to come up with the incorrect an incorrect output, where your sample does not match up with the population of the total. It's going to happen. And if you audit to the 95% level, what does that mean? That means 5% of the time you're going to get it wrong. 95% level means 1 in 20 times you're going to get it wrong. It has to be that way. Any given one, you're probably pretty confident in, because there's a 95% chance that you're on the right path. However, statistically, 1 in 20, the sample is not going to match up. Now, hopefully, again, it matches up being, that you come up that it's that you can't rely on the controls when you actually could. The controls are better than you thought. You'll have an inefficient audit, but you'll come up with the correct conclusion rather than the other one incorrect. So incorrect acceptance is actually the dangerous one. This is the one that people want to try to avoid, more so than the incorrect rejection, which just means you do more work. Question on that? Okay, same thing is true for the substantive testing. Whether you're using the, funny way I have it here, whether you're using the classical sampling or the monetary unit sampling, You know, these are for dollar amounts. They're for material misstatements. And so whether you're using the classical sampling method or the monetary unit sampling, you're going to run into the same thing. You know, the Boy, does this look terrible? Hold on. There, I made it even worse. How about that? You guys didn't think it was possible, but I did. All right, so again, you know, you would assume that they are not materially misstated. So this would be incorrect rejection that they are that they're materially misstated, basically. And this would be incorrect acceptance, where you think, oh, they're not materially misstated when actually they are. So the same type of table is used for both of these. The wording might be a little different, but basically it's the same. Okay. Last little thing. I think this will be we'll stop after this. Relationship between test controls and substantive procedures. Okay. Testing controls. You know, why are you doing the test controls? You're not required to do test of controls. You don't have to do them. You only need to do them if you are going to rely on the internal controls. So you're required to get an understanding of internal controls, but you're not required to do testing on internal controls unless you rely on them. So you can get an understanding and say, okay, I understand internal controls of the place. That will help me determine where things can go wrong. However, let's say I'm falling off a ship here. However, I'm not going to use them. You know, so if you're not going to rely on the internal controls, you're just going to do a bunch of substantive testing. You know, okay, instead of looking at the internal controls and then doing testing of 200 items, forget the internal controls. I'm just going to go grab a test of 600 items. You know, I'm really going to test the daylights out of substantive testing, get the dollar amounts. But if you are testing the internal controls, you want to know if you can rely on them. That's the only reason why you're doing it. You're not doing it for some academic, gee, I wonder how the controls are doing. You only test the internal controls if you're going to rely on them. Okay, so you're looking to see if you can rely on them. Now, if you can't rely on them, then you know you got to jump to the substantive testing. Okay, so back to our problem. So suppose the initial test of controls indicate that the controls cannot be relied upon. So you're starting to do testing and the testing controls are not very good. You can't rely upon. So what are you going to do? Are you going to increase the test of controls? Or increase the substantive testing?
Increase the substantive
Yep.
procedures.
Yes, exactly. That's exactly it. There's no reason to keep testing here if you can't rely on it. So what you will do is, you know, what you will decrease these. You know, you get through a few of them and you just can't, you know, you realize you're not going to be able to rely on these. So you will decrease the test of controls and you will increase the substantive testing. say, okay, we can't rely on these controls, we're just gonna grab more. More invoices instead of, a couple hundred invoices, we'll grab 500 invoices or whatever it is. Now. The relationship between testing controls and substantive procedures. And substantive procedures. Is inverse. Oops, that's not how you spell it. Is inverse. The more you do of one, the less you do of the other one. Now, if you're doing tests of controls and they seem pretty good, like you can rely on them, you'll do more tests of controls and fewer substantive tests. If you can rely on the controls, say, okay, well, these controls seem like they're working pretty well, and everything we've gone through looks like they're doing what they're supposed to do. We don't need to test as much of the substantive testing. Instead of grabbing 300 items, maybe we'll grab 180 items or something like that. We can actually decrease the amount. So it's inverse. And the auditors don't usually plan on that ahead of time. It's usually when they start doing the test of controls that they determine whether the only reason why they usually test controls is that it will be more efficient overall for the audit. That's the only reason why they're doing it. It's not some academic thing to know whether the controls are or whatever. It's because they say, okay, if I get comfortable with these internal controls, I can really reduce the substantive testing, and the audit will be done quicker, cheaper. I'll be happier. The client will be happier. Everybody will be happier. So they want to rely on the internal control. That's the only reason why they do the testing of it. But if they can't rely on the controls, reduce the testing of internal controls and just rely on substantive testing. Now, they can, right off the bat, say, look, I'm not going to look at these internal controls. I'm just going to write to substantive testing. For example, let's say that, there was a, actually it was a fraud case, but regardless, Jack Nicklaus was a famous golfer, kind of like Tiger Woods back in his day. Back in the 60s and 70s, Jack Nicklaus was kind of like Tiger Woods. Anyway, he built golf courses, and he was building like, I think, 7 or 8 golf courses. But anyway, it wouldn't make sense to look at the internal controls that they were having for these golf courses, because you could simply do a substantive test of all of them. All of them are material, so you look at all of them rather than look at the controls. Now they're, it really depends on what you're looking at, whether you can just ignore the controls or not. But the only reason why you're looking at the tested controls is so that you can reduce the overall sample. That reduce the amount of time for all of your sampling by relying on the control. Okay, I think that's it. That's it for that one. Hey. All right, let's just stop there. All right, so we have 2 things we can turn in now. We'll do this next week. So we'll start chapter 13 next week. Man. Okay, so we just finished up the chapter 12 handout and the sampling overview. And we'll do 13 next week. Okay, any questions? Hey, look at that. 7:37. What is that? 23 minutes. All right. Any questions on anything? Okay, so you can turn those 2 things in. And then I'll see you guys. Wait, I think we had a test the test due this Friday? Chapter 11 test is due by this Friday. So just make sure you get that in. Any questions? Okay. Have a good weekend.
You
Alright.
too, thank you.
Good night.
Professor, can you go back?
Professor.
Yeah,
Good
go
night,
ahead.
thank you.